We're joined live here in Zurich by Florian Esterer. He's a senior portfolio manager at Swisscanto Asset Management. Florian, before the break, you were telling me that actually Credit Suisse wasn't too bad, but there is a little bit of disappointment in some of the divisions. What is your biggest concern for Credit Suisse?
Well, I think what we've seen is that last year the investment banking was very strong. And that got dampened with Q4 and Q1 numbers, where the company said they were taking down risk a little bit, being a little bit more conservative. So what we expected now was that they actually have more resilient earnings versus their peers. But what happened was that their revenues were right in line with the US peers. So it seems they don't fare much better even with reduced risk. So I think what the analyst community now comes out with is that the numbers we saw last year were really exceptional, and what we're seeing now is probably more reasonable level of revenues.
What about net inflows, for example, in the private banking unit? This seems to be encouraging news. Does that mean that they will continue to pick up and this trend will continue at least well into next year?
Yes, I think what's happened is actually fairly healthy for the company. I think last year, the company was dominated by the investment banking. Now that that's being scaled back a little bit, I think the good private banking numbers, the continued good inflows are coming to the fore. The company is being rebalanced a little bit to private banking. We still have some margin issues there, but I think the process we're seeing of rebalancing is quite healthy.
Now, Florian, we know that of course, Switzerland is not part of the EU. It's as simple as that. So that's why Swiss banks don't have to publish their stress tests tomorrow like the rest of Europe. But we've seen a lot of lobbying, for example, from the Swiss Banking Association saying, well, guys, you have great ratios. You're doing better than your peers. Why not publish them at the same time?
Well, I think that'd be very reasonable. I think there aren't many concerns around the viability of the Swiss banks at this point in time, right? So we have the two big ones, and the rest of the banks aren't really exposed to what would be an issue under the stress test. And I think for the two big banks, we have solid capital ratios, and I think we have decent transparency on their holdings anyway.
So you would urge them to actually publish a stress test, the same stress test as the rest of Europe is doing, possibly at the same time?
Well, if they get around to doing that, I don't think it's an urgent issue for them, but I don't think it'll be a negative for them either.
Now, Florian, there's also, of course, we've been covering, these stress tests for the last 2 weeks, and there's a big problem of credibility. The markets still don't believe that actually this will give the support that the markets need. Where do you stand on this? At least they're being published.
Right, yes. So I think at the start, we can say we get a little bit more transparency, and that can't be anything but a good thing, right? So at least we can have a better understanding of what's happening. I think where there's a lot of concern is around sort of the assumptions taken under the stress test. But I think if the transparency on the underlying positions is good enough, you can come up with your own numbers, basically.
But so what are you concerned about? For example, that the haircut is not strong enough for sovereign debt being held in Italy or Greece or, Spain?
Yeah, I think the EU and the CEOPS is tiptoeing around the question of what happens if there's a sovereign default, right? And the sovereign default would then mean that actually the positions held in the held to maturity bucket, which is not mark to market, will have to be written down. And that is currently, as is our understanding, not part of the stress test, but that is, I guess, the base assumption in most of the market participants.
Yeah, and at the moment, the scenario doesn't actually say that a country is default. And do you think it would? It needs to?
Well, at least that. I think we will see some defaults, and I think, given if I look at the prices on some of these debts,
not private sector defaults. You think we'll see country defaults or private sector defaults?
No, we'll see country defaults. If I look at the prices of these bonds and the CDS, there's a default pricing.
But what, Portugal? What countries?
Greece definitely. Greece definitely. I think Portugal is questionable. I don't think anybody expects Italy to default or Spain.
So you really think that Greece will default by the end of the year or into 2011?
More like 2012 to 2013.
Okay, interesting. I just wanted, quickly to also get onto the fact that we're publishing these stress tests. This is what we know so far. Tomorrow, after the market close. Now, there seems to be a little bit of unnerve from some of the banks saying, well, because I'm also in the U.S. market, I'll be hit, whereas the other banks will have 48 hours to explain to the markets before, trading day starts in Europe on Monday. Do we need to bring this forward?
Well, I think there was nothing constraining the banks from putting out their own statements at 6 o'clock, right? So they knew this was coming. They knew what the result was. They couldn't put out their own statement at 6 o'clock. I think it's very difficult for to find a time, place when every market is closed. So I don't think, I think they're making more of an issue than it really is.
Yeah, keep it as it is. Florian, thank you so much.
Sure.
Florian Esterer there.